All right, today we're going to tackle a financial product that can seem, a little complicated. Index Universal Life Insurance, or IULs for short. We are going to pull back the curtain and look at what you actually pay for. We'll break down the premium, the internal costs, and even look at a real expense report to see exactly where your money goes. Let's just jump right in.
Okay, so let's get right to the heart of it with this one big question. Is the premium you pay the real cost of the policy? Now think about it. For pretty much every other kind of insurance you have, your car, your home, your health insurance, the answer is a simple yes. You pay the bill, that's the cost. But with an IUL, the answer is a big, fat no.
And this is really the key difference right here. On one side, with most insurance, it's simple. Premium equals cost. End of story. But on the other side, with an IUL, your premium payment and the policy's internal costs are two totally separate things. How much you decide to pay is actually a strategic choice, not just a bill you have to cover.
So how is that even possible? Well, it's all thanks to a feature called a flexible premium. Here's how it works. The insurance company sets a minimum amount you have to pay just to keep the policy going. But then, on the other end of the spectrum, the IRS sets a maximum amount you're allowed to put in each year to keep all those nice tax advantages. And that creates this huge range where you get to decide how much you want to fund it.
And all that flexibility, it creates what we call the IUL funding spectrum. It basically means the policy can be used for totally different goals. You can use it for just basic insurance coverage, or you can crank it up and use it as a really powerful tool for accumulating cash. So let's break down what that spectrum actually looks like.
You can basically think of it in three main levels. First, you've got the minimum premium. If you pay this, you're just treading water. It covers the policy's costs, and that's it. You build zero cash value. Then there's the target premium. This is a great starting point if your goal is to actually build up some good cash value. But the real magic, that happens at the third level, the maximum premium. This is the limit set by the IRS, and it's designed for one thing, maximum tax-advantaged growth.
And check this out. This is what's so wild. The difference between the minimum and the maximum can be absolutely massive. For this hypothetical 35-year-old guy, the minimum premium just to keep the lights on is about $3,500 a year. But the maximum he's allowed to contribute to build wealth, $60,000. I mean, that is a huge difference in strategy.
Now, this is the one thing you've got to lock in your brain. Every single dollar you pay above the policy's actual annual cost goes directly into your cash value. That cash value, that's the engine of the whole thing. That's the part that gets credited with interest and really starts to compound and grow over time.
Okay, so that makes you wonder, right? Where does that cost portion of your premium actually go? What are you really paying for? Let's pop the hood and take a look at the anatomy of the internal charges. First up, you've got the premium charge. Think of it as a small slice off the top of every payment you make. It's usually somewhere between 5 to 10%, and it's used to pay the insurance company back for things like state taxes and general admin expenses. All right, next up is the policy issue charge. This is a fixed fee that covers all the upfront work of getting your policy set up, the medical exam, the underwriting, all that. But here's the key thing to remember. It's not forever. This charge typically only applies for the first 10 years or so, and then, poof, it's gone. Completely disappears. And then, of course, you have optional charges for what are called riders. These are basically add-ons you can choose to bolt onto your policy for extra benefits. So you might add a child rider to insure your kids, or living benefit riders that let you get your hands on your death benefit early if you get diagnosed with a serious illness. Okay, this is where it all comes together. This is the good part. We're going to look at what's called the crossover point, that awesome moment when the policy's growth actually starts to outpace its own internal costs. So take a look at this. This is a 5-year breakdown for our example. Over those 5 years, a total of about $317,000 in premiums was paid. Now, here are the two numbers you really need to see. The total charges, the costs that were deducted, were about $37,000. But the total interest that was credited back to the cash value was over $57,000. So let's put that first number under a microscope. $36,834. That's it. That is the actual price tag for all the insurance coverage and all the fees over 5 whole years. Now hold that cost in your head and look at this one. The growth? $57,767. So, it's not even close, right? The growth generated by the policy's engine completely blew past the total internal costs. And what happens when you put those two numbers together? You get this, a net gain of nearly $21,000.
That's pure, tax-free profit that's left over after every single internal policy charge has been paid for. The policy literally paid for itself and then some.
And here is the bottom line. It's an incredible moment. At this point, the total cash value sitting inside the policy is actually more than the total amount of premiums you've paid in. Just think about that for a second. The policy is now effectively paying you to have it, all while still providing that death benefit protection.
And this is why you hear people say this. It totally reframes how you should be thinking about it. Life insurance isn't just insurance on your life. It's insurance for your investments. It's not about competing with your other investments. It's about protecting them. If a major life event happens, you can tap into your policy's cash value instead of being forced to panic sell your stocks or your real estate when the market is down.
So look, if we know the costs are just part of the system, and we know the growth can easily outpace them, that leads to the really big question, doesn't it? How do you actually use all that cash value to its absolute full potential? And that, my friends, brings us to the whole concept of policy loans, of becoming your own bank. But we're going to have to save that one for next time.